If you've been watching the news at all, you've probably heard all the noise and excitement from the president, from the federal housing administration, from policymakers who are floating this radical proposal to solve what they call the affordability crisis when it comes to real estate. And the way they're saying they can do this is with what is called the 50-year mortgage. Yeah, you heard me right. The 50-year mortgage. Basically, for half a century, you have payments on your house. So if you sign and buy a house when you're 30, you actually won't own that house and have it free and clear until you are 80 years old. I think the average male only lives to like 75. Let's look that up. So you wouldn't even own this house while you're alive based upon the 50-year mortgage. Now, to the average person, this sounds like a complete debt trap. And honestly, for the unaware homebuyer, it really is. But you're not the average homebuyer. You're here because you want to be a profitable real estate investor. And here's the truth that the news isn't telling you anything about. The policy isn't just about lowering payments. It's a fundamental shift in the amortization mechanics of real estate. So for the uneducated investor, this is a landmine. But for the smart investor, the one who understands debt service coverage ratios, DSCR, this is a solvency mechanism that can literally save your portfolio. Today, I'm going to put on my experience guide hat and I'll discuss the pros and the cons in this new 50-year mortgage plan for the real estate industry, and especially how it's going to affect us, the fix and flip real estate investors. I'm Ryan G. Wright. I have been fix and flipping properties since 2000. I've seen the ugly and the beautiful of the industry, including COVID, 2008, and you name it. And I speak from my experience, what I have seen firsthand in the over 25 years that I've been investing in real estate. So first, let's talk about the advantages. These are the factors that can save your deal in this high interest market that we're currently in. I say that with quotes because some would say this is low. When I started, interest rates were in the 8%, higher than where they're at right now. But that's a video for another day. The single biggest pro is an expansion of the buy box for the DTI constraint borrowers. DTI meaning debt to income ratio. That's what that means. And so we're in a market where higher interest rates have disqualified millions based upon their debt to income ratio, DTI ratio. And potential buyers are disqualified not by credit worthiness, they've got good credit and everything else, but by a marginal deficiency in the monthly payment capacity, which basically means that their total debt is too high compared to the ratio of income that they're coming in with, which means they can't qualify for a bigger house or more expensive house. So the 50-year mortgage acts as a lever to fix this. Now, let's be accurate with the math. Usually a longer term is going to come with slightly higher rates. You're probably not going to get the same rates on a 30-year loan as you are as a 50-year loan, but they're not substantial, roughly a quarter to 0.5% higher in most cases. I mean, we'll see. This is all a proposal. We'll see how this plays out. However, even with that higher rate, once you stretch your principal payments over 600 months, yes, I said 600 months rather than 300 months, that's going to lower the required monthly payment. Now, it might only save $200 or $300 a month in actual cash flow, but that small drop is exactly enough to get many families under that 43% DTI or debt to income limit ratio in order for them to qualify for the house that they may not have qualified for, or be able to buy a bigger house that they wouldn't have been able to due to this debt to income limitation. This will bring payment buyers back into the pool. These are people who need the payment to work, regardless of the total interest cost. These are people who care about having a home, not the total interest cost. That's really what it comes down to. The second major pro is asset inflation and buying power. You have to understand that how the average American thinks. They don't buy on price, they buy on payment. How much is it going to cost me monthly? So when you lower the payment, you increase the buying power for those individuals. This is economics 101, and it tells us when the buying power goes up, prices go up as well. This is a massive pro for us as investors holding inventory or renting properties. As this policy rolls out, we're going to see market appreciation. We just are. The third pro is your safety net. And this is the DSCR refinance. Sometimes the market freezes. You can't sell. If that's happening, you're usually trapped in a high interest hard money loan. But the extended mortgage term opens up new exits in terms of turning them into rental properties. We're already seeing this in the market right now. There's DSCR lenders right now that are offering up to 40-year loans, and some even offer interest-only payments for the first 10 years. And when we say DSCR, it's debt service coverage ratio. That's what we're talking about here, is the ratio of the income compared to the debt on that specific property is what they're concerned about. So this makes a rental property incredibly attractive. By lowering the debt service with a 40 or 50-year term, a property that would have negative cash flow on a 30-year loan can actually suddenly positive cash flow. And this allows you to refinance out of your hard money loan. It allows you to hold the property as a cash flowing rental until you're ready to sell, or for as long as you may want to have that property. Now, the fourth pro is flexibility and control. Critics love to scream about the interest rate monster. They say you pay so much interest on a 50-year loan. And yes, if you pay the minimums for 50 years, that is true. But there's a secret, and this is it. You control the loan payment. The loan doesn't control you. You can take out a 50-year mortgage to lock in an ultra low mandatory payment. That's your safety net. But at any time, you can choose to pay more. You can pay it like a 5-year loan, a 20-year loan, a 30-year loan, whatever you'd like to. You can make that payment towards it if you would like to, so that you can pay it off early. So that gives you options, especially if your income's going up, especially if rents are going up, lots of different options, which is what we want as investors. So if you came in here and got a 50-year loan and your house value doubled versus you renting and having to come up here and buy that house at the $400,000, was that worth paying a little bit extra interest for? I think the answer to that question is yes for most people, because you're securing the asset and tying it down at a lower price, although you're going to have interest payments longer. But like we said, you can choose to make those principal payments whenever you want to, so you can pay down more if that makes sense for you. This gives you the best of both worlds. You lock down an asset at today's prices, you capture the appreciation that we've been talking about, and you have the option to pay it off early to kill the interest while keeping your required monthly obligation low. However, to be fair, we also have to look at the other side of the coin. There is a significant con that, if ignored, will crush your fix and flip business. The most dangerous con is the acquisition squeeze. Remember how I said increased buying power drives up prices? That's great when you're a seller, but it's very tough when you are buying. When the floor for all residential assets rise, distressed properties become more expensive to acquire. So the days of simply finding deals on the MLS are really gone. You're going to have to dig deeper. You're going to have to find deals that make sense, because the competition and prices are going to be stiffer. In other words, you need a way to find off-market deals to stay in the game. Another major con is the reduction of inventory. The 50-year mortgage isn't just for buying, it's a foreclosure prevention tool, meaning the banks can now modify those struggling payments into 50-year loans to keep people in their homes rather than seeing those homes get foreclosed. This will reduce the supply of foreclosures coming into the market by 15 to 20% and maybe even more. This means fewer distressed deals for you to find. And finally, You have to consider the equity buyer rejection. Not everybody wants that 50-year loan. Financially literate buyers understand this interest cost. And if you flip a luxury home, your buyer will likely be an equity buyer who will reject this product. This means that 50-year mortgage strategy works best for starter homes and medium price assets, not for luxury mansions, which we always recommend avoiding. So, what's the verdict? The 50-year mortgage, it's simply a tool. It's a massive transfer of wealth, and it aids the flipper by subsidizing the exit and driving appreciation, but it punishes the uneducated investor by inflating the entry price and hiding the interest costs. You've got to understand that while interest rates on a 50-year loan are higher, you're trying to tie down the asset at a lower price today and capture the future growth value over time. This is what we call appreciation. And most importantly, you need to ensure that you have a system to find deals that others are missing. And that's exactly why at the Investor's Edge, we've built the Find, Fund, Flip system. This is the only system in the market that teaches you everything about fix and flipping. It's the only system that allows you to find off-market deals to beat the inventory shortage. It's also the only system that gives you access to 100% financing with hard money loans directly from us. And moreover, it gives you access to a community filled with experienced professionals available round the clock to help you profit. That is simply what we do. This system will allow you to use this new 50-year mortgage as a stepping stone for higher profits. To learn more about our Find, Fund, Flip system and how it works, click the link in the description below. Don't let the headlines scare you. Let the math guide you. I'm Ryan G. Wright. Find, Fund, Flip, and I'll see you on the inside.